All right, we're looking at futures up after an official correction yesterday, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak off on assignment, and Bloomberg Open Interest starts right now.
Coming up, bouncing back stocks looking to recover some ground after sliding into correction territory yesterday, with the S&P 500 capping a 10% plunge from its peak in mid-February. However, Bank of America strategist Michael Arnott says this is a technical correction and not the beginning of a bear market. On Open Interest today, Greg Boutle of BNP Paribas and Rob Arnott of Research Affiliates will weigh in. Plus, Senate Democratic leader Chuck Schumer backs down from his threat to block a Republican spending bill on concern a government shutdown would hurt the U.S. economy and reflect poorly on the Democratic Party. Katie?
All right, all that and more coming up. Let's take a look at these markets just all over the place. As Matt said, finally entering correction territory yesterday. You're seeing the dead cat bounce today, up about 1% on the S&P 500 pre-market, even more when you take a look at the NASDAQ 100. Even still, even if we hold these gains, this is shaping up to be perhaps the worst week of the year, depending on how we finish up. Heading into the close yesterday, the S&P 500 was down 4.3% for the week, so we'll keep a close eye. And then you take a look at the bond market right now. Yields actually rising, not so much of a haven bid. There wasn't a haven bid yesterday either. We are camped out at 4.30 on your 10-year Treasury yield. But let's take a look under the hood. We know that big tech has been leading the way down, and as such, Tesla, one of the stocks right now that's leading the rebound for the Magnificent Seven after that S&P 500 fall into correction territory yesterday. Pre-market up 2.4%, but let's take a look at the year-to-date. For 2025, it is just incredible. Tesla shares down 40% so far this year. So even with a 2% rise, that's not going to do much to dig out of this hole.
Yeah, still up 500% over the last 5 years.
Zoom out.
If you zoom out, it looks much better. Nvidia also helping to propel the rebound today. You can see in the pre-market up 2.8%. And of course, this is the second biggest company in the world. It's worth $2.8 trillion. Take a look year to date. Nvidia had lost over $1 trillion in market cap this year. It's recovered a little bit of that, so it's now down $840 billion in market cap from its peak in January. If you look at this stock over the last 5 years, it's still up more than 1,800%. In fact, 2,253%. So more than quadrupling the gains that we've seen in Tesla. Now, former Treasury Secretary Steve Mnuchin is dismissing concerns of a U.S. recession. Speaking to Bloomberg today, he downplayed the recent sell-off in equities and advised investors against overreacting to President Trump's trade tactics.
I know there's some talk about, are we going to go into a recession? I don't see us at all going into a recession. I think we could have a little bit of a slowdown in the economy as we pull back on government spending, but I don't think investors should be concerned about a recession. A 5 to 10% correction on the S&P or the NASDAQ actually makes sense. The market's been really fueled by massive amounts of tech spending, particularly around AI. So some of this is a natural correction.
All right, that was Steve Mnuchin, former Treasury Secretary. I know you're going to bring up Michael Arnott.
I am chomping at the bit
from
here.
Bank of America.
Yeah.
To me, the most interesting thing that he said was in regards to policy, that fresh declines in stocks would flip Trump's trade policy and the Fed's monetary policy.
So two things. One, I think your chair is too low. Once again, we are at eye height, which is not reflective of reality. We'll work on it in the commercial break.
There we go.
The other thing is, you're exactly right, and that's why this Arnott note was so interesting, saying that this isn't the start of a bear market, it's just a technical correction, and that basically, since equity bear markets threaten a recession, before we get there, we're going to see the flip in trade and monetary policy.
Hey, so you're reading a quote.
I am reading a quote.
I bet we have a tear.
Amazing, there it is. So he's basically saying that like, even though we have learned that Trump wasn't bluffing when it comes to tariffs, that truly he meant what he said on the campaign trail, Hartnett's still kind of taking the other side and saying at a certain point that Trump put will kick in.
Right. He says buy stocks at 5,300, which to me also indicates he thinks we have further room to fall. Gina Martin-Adams joining us now, Bloomberg Intelligence Chief Equity Strategist. Gina, great to have you on the program this morning. Thanks for joining us on Open Interest. What do you think about, it's not just Michael Hartnett who says we're going to go down to 5,300. Then you can buy, Mike Wilson says 5,500. Then we're going to go back to 6,500. JP Morgan says 5,200. Then we're going to go back to 64, 65. So everybody seems to be saying we have further to fall, but then it's good for the rest of the year.
Yeah, I think it's very interesting because that's a whole lot of certainty in a world of incredible uncertainty. I would say that the charts have definitely deteriorated significantly, and that's probably the biggest reason why many strategists are capitulating to a more bearish near-term condition. The degree of decline that we saw in momentum this week alone is much greater than you would normally see for an equity correction limited to 10%. And I think that as a red flag is creating a bit of a sentiment washout in the strategist community. But then you hear things like the president will step in if the bear market gets to be too big, and you start to wonder how much we're still holding on to these old notions that there is some form of a Trump put or some form of a Fed put that is going to save the equity market. So I would say sentiment broadly is a little bit more mixed, even though we're deferring to the sell-side strategist community that has started to really dismantle their bullish case for stocks that they had at the beginning of the year. The broader sentiment is still a bit hopeful, still a bit buy the dip in mentality. We certainly see that in ETF flows, as our ETF team produced a report this year suggesting there is no evidence of capitulation from the retail investor just yet. So I think it's a bit more mixed in terms of sentiment.
You make a number of interesting points there. You talk about the deterioration in the charts. I don't think we have it, but if you look at the S&P 500's 200-day moving average, there was some talk that maybe that would act as support. Instead, we sliced right through it. Didn't even really pause. You also mentioned the ETF flows, and there's all this talk about retail being sort of the panicky, flighty sort of money. But then you take a look at the ETF flows, and it's just this constant bid into the Vanguard type funds of the world, which is also really telling. But talk to us a bit more about sentiment, because then you take a look at the AAII survey registering extreme pessimism. You could read that as maybe that everyone who wanted to sell already has.
Yeah, so there's a lot of different ways that you can cover sentiment, right? AAII is one. That's what people say, not necessarily what they're doing. We tend to focus much more closely on the market dynamics themselves as a proxy for sentiment. We have our own market pulse model. This model is composed of several indicators of market internals, like pairwise correlations, which have definitely started to rise, but are not even back to long-term median. Or breadth, which has really just started to break down, with now just under 50% of stocks trading above their 200-day moving average. Or small cap signals, or high yield signals. So when we look at the composite of the 6 components that go into our market pulse index, we actually find the market, at least as of the end of February, was still somewhat manic. There's a long way to go to get from manic to true panic on our sentiment survey. And most of the indicators would suggest we're still nowhere near panic levels in the equity market. Even with the incredible drawdown in momentum, the fact that we're still so high above our long-term uptrend line is telling us something. We got to somewhat irrational exuberance at the start of this year. We see this play out in earnings as well. And if I could take another minute, I'd just like to dig into earnings sentiment, because this, I think, is one of the more fascinating things affecting markets this year. Coming into 2025, the market itself was priced for, we believe, close to 24% earnings growth to emerge this year. That is an enormous hurdle for companies to overcome. 20% earnings growth just doesn't happen very often. It only happens following recession experiences, in fact. So to get 20% earnings growth was next to impossible. The market itself has only modestly downshifted on earnings expectations. The market is now expecting just under 20% earnings growth by our calculations. That's still too high considering the degree of economic momentum loss that we've already had and the potential for greater economic momentum loss that we might have if tariffs are continuously imposed over the course of the spring.
All right, Gina, great to get some time with you, especially on today of all days. That is Gina Martin-Adams of Bloomberg Intelligence. You take a check on futures right now after we finally hit correction territory on the S&P 500, bouncing back today. The S&P 500 up about 1% pre-market. The NASDAQ 100, your big loser as of late, up a little bit more, up about 1.3%. And the small caps hanging in there as well. The Russell 2000 up about 1.1%. Something that I keep thinking of, Matt, we keep calling it a technical correction. Why don't we just say correction?
We could, actually.
Yeah.
I think that's just to put a little bit of more clarity around it. We define a correction as a 10% drop from the peak. Other people could think of it differently. The NASDAQ you mentioned is down more, right? 13% from the peak. By the way, $5 trillion have been wiped off of global stocks, but Michael Hartnett, of U.S. stocks, but Michael Hartnett in his B of A note that you sent me this morning points out that 186 billion have come into global stocks. It's seen inflows still globally, and he likes international stocks better.
He is part of an increasingly loud chorus when it comes to looking outside of just the U.S. We'll continue to follow that trade. We're also keeping an eye on Tesla, as we mentioned, really one of the stocks leading the rebound this morning among the Magnificent Seven, up about 2.4% right now. But we know it's been a very fickle trade, Matt Miller.
Yeah, I just pulled up on NVIDIA, when you put equity, you can type WGT and see how much any equity is worth in an index. So NVIDIA is worth more than 6% of the S&P. It's worth more than almost 8% of the NASDAQ 100. And so that $2.8 trillion mover has a lot of weight behind it.
Takes a bite out of it.
Yeah, and or add some to it, right? If we see NVIDIA shares continue on the path that they are on now, and the pre-market, you can see up almost 3%, that's going to do a lot of good for the broader indexes. Still ahead, more insight on this painful week for markets with Greg Boutle, top strategist at BNP Paribas. And then Rob Arnott joins us, founder and, I guess, a pioneer of smart beta.
The godfather of smart beta.
Yeah, joins us from research affiliates. Plus, Democrats in discord as the government shutdown risk fades away as they roll over, they back away. Trump wins, at least on this one. More next. This is Open Interest. Getting out of high interest, look at what's making headlines around the world. Democrats are backing off their threat to shut down the government. U.S. Senate Minority Leader Chuck Schumer said a shutdown, quote, would give Donald Trump and Elon Musk carte blanche to destroy vital government services at a significantly faster rate than they can right now. A vote on the bill will take place this afternoon. Germany's Friedrich Merz says his party has won the backing of the Greens for his fiscal reform plan. The announcement follows earlier reporting by Bloomberg that an agreement had been reached. The deal is pending approval by party lawmakers, but German bond yields, which have surged by more than 50 basis points, slid to extend a recent drop on the report. And NATO Secretary General Mark Rutte told Bloomberg this morning that relations with Russia should eventually normalize after the fighting ends in Ukraine. Rutte spoke with Bloomberg after meeting with President Trump. He said that nations in the alliance should aim to boost defense spending to at least 3% of GDP, and that President Trump was not going to back away from NATO.
It was a very positive meeting, and also an absolute clear commitment to the alliance, to NATO, to what the alliance stands for. So it was very optimistic and very positive. I tell some of my European colleagues when they say, well, is the US still connected and committed to NATO? I tell them, you might want to turn on your television and listen to the president when he says this. I have no doubt, and there is no reason to doubt that.
All right, let's bring it back to the U.S. equity market right now. Quick check on futures ahead of the opening bell. You can see we're seeing a bit of a turnaround Friday. Whether or not that's sustainable We'll find out. But the S&P 500 up about 0.9% pre-market. The Nasdaq 100 leading your gains right now, leading the bounce back, up about 1.2%. And small caps also in fighting mode right now, up about 1.1%. Of course, we finally hit that technical correction yesterday on the S&P 500. It took 16 days to fall 10% from the February high. That is the 7th fastest correction in records going back to 1929, according to Bloomberg data. So we'll continue to monitor that situation and discuss it up next with Greg Boutle of BNP Paribas. He'll offer his thoughts on whether stocks have hit their low after finally hitting that correction. That's next on Open Interest. All right, welcome back to Open Interest. It's shaping up to be a big Friday, a big rebound in these markets after we hit correction territory yesterday. The S&P 500 up about 0.8%. Those gains lessening a little bit as we are just minutes away from the opening bell. Let's discuss all of this action with Greg Boutle. He is BNP Paribas U.S. Head of Equity and Derivative Strategy. Great to have you in person, Greg.
Thank you for having me.
So we finally hit correction territory. It feels like a lot of folks had been waiting for it, saying that once we finally get to that 10% threshold, maybe we're all flushed out and we can start buying again. What's your read on positioning and sentiment?
Yeah, it doesn't feel like we've seen a capitulation from the data that we've seen. I mean, if you just look at simple measures like ETF inflows over the last month, there's been $40 billion put to work in the US equity market. So that is really the reverse of a capitulation from that pocket of flows.
So Gina Martin Adams was on Open Interest at the top of the show, and she was saying at the beginning of the year, this market was looking like 24% earnings growth. At least that's how it was priced, right? That's obviously come down, but what do you think about valuations now, and what do you expect for earnings growth?
Yeah, I think one of the issues with this correction is that you like to look for valuations to provide some support, but we came in this year at such elevated valuations that a 10% drawdown doesn't do an awful lot for that. The S&P is still on a 20 times forward multiple. So I don't think it's valuations that we'll be looking to call the trough here. It is more thinking about things like capitulation in terms of positioning or changes in terms of the growth outlook or the data points to drive that.
Interesting. I mean, I was going to ask what will ultimately put a floor into this sell-off, what's ultimately going to provide that support. It hasn't been valuations. It certainly hasn't been technicals. It sounds like you're saying we just need to get everyone washed out, basically.
Yeah, I think there's kind of maybe 3 or 4 things we'd look for. One of them is evidence of a policy put, whether that's a Fed put or a fiscal put. I think if we see those things, they're likely to be lower than where we are now. One could be an inflection in the data. People have been increasingly more worried about what's going on in the growth picture. So we have some survey data in about 40 minutes. We have retail sales next week. An inflection in the data that gives people comfort. That could help. And then the final thing is capitulation, I think, in terms of positioning.
Well, what's interesting when it comes to the data, we got some pretty good inflation readings this week. We had CPI coming in cooler than expected.
Yeah.
Cooler than expected.
True. No, I agree that the data points this week looked good. I'm not sure if they're going to keep looking that good.
That's true. That's the worry. But I don't know. When you put together CPI and PPI, which was basically unchanged, there's the idea out there that gives the Fed some room to cut rates, actually, should we see growth really deteriorate, as some people expect.
When do those guys meet? When do those guys have that decision?
I think that's on Wednesday.
Yeah.
I'll be in Colorado. But what do you make of that, you know, we do have maybe some runway for the Fed to ease here, but that's not helping sentiment at all.
Yeah, I think the issue, enemy number one, if you like, for the market is growth rather than inflation at this point. So I think if we were to see the Fed cut quicker than people expect, it's because growth has got worse. So I think maybe we have to take a little bit of pain more, but first before we get to that. So softer inflation, all else equal, I think is helpful, but really I think it's growth that people care more about. And if we get softer inflation but much softer growth, I'm not sure in the short term that helps.
So we're not going to know about growth for a while, right? We have to see what Trump does, how everyone responds, then how he retaliates, et cetera. But we have seen kind of a rebalancing of this market, right? Because the Mag 7 is off 20% from their highs. The NASDAQ, as we were talking about, is off 13%. The S&P is only off 10%. So does that make you feel more comfortable about the concentration risk that we had worried about so much last year?
I mean, it helps a little bit in terms of the concentration risk, but ultimately what we really worry about in the case that we get a deeper bear market is that you get a correlated sell-off. And I don't think what we've seen there really mitigates that risk. So I think the scenario that would make us much more bearish is if the news flow or the cracks that maybe have emerged around the edge of the AI story, CapEx, DeepSeek, continue, and at the same time you get softer data, and that can drive a sell-off both in the more cyclical parts of the market and that kind of secular growth story, and that could create a more correlated sell-off that could drive more of that capitulation and a much more volatile de-risking than what we've seen to date.
So, but I'm watching NVIDIA very closely today. Yep. That stock, that sector has been on fire, obviously, if you back off, because of AI, right?
Yep.
Is that still going to be one of the dominant threads this year if the market does recover to 6,500, as so many people seem to think it's going to?
I mean, tech is simply the biggest sector in the US, and despite that small decrease in the concentration that you mentioned, they are the dominant weights in the major US indices. So NVIDIA has an event next week, and people are going to be looking very closely to that to provide some comfort for that story for the Mag 7. So I do think it's possible to have decoupling. You can have other regions pick up some of the slack. You can have the industrial cyclical parts of the economy pick up some of the slack. But ultimately, for the major US benchmarks, where tech goes is going to remain the most important driver this year.
I will say that I'm looking at S&P, ANR, and BNP Paribas has 6,300.
6,300, year-end price target. Well, I don't know. We'll see if we get there. But I do want to talk about the rest of the world, because something we've seen emerge in the past couple of weeks is folks saying that what we're seeing in European outperformance, that has legs. What we're seeing in the Chinese equity market, maybe we're going to get more stimulus next week, that trade also has legs. What's your feeling? Yeah,
so coming into this year, I think that my colleagues in Europe had a great call in terms of European outperformance, and it's worked incredibly well. But perhaps in the short term it's worked too well. There has been this very large divergence into performance. I think some of that is flow driven. The US equity market is so much larger and more liquid than other regions that if you slice a small piece of your allocation off the most liquid names in the US and put it to work elsewhere in the market, that has a big flow effect there. But we have seen a very big discrepancy between that performance. And ultimately, I think what happens in the US matters for the rest of the world. If you do have a more bearish scenario play out in the US, then economies such as Europe are quite export heavy. They are quite cyclical. It's hard for them to entirely decouple.
If they spend $2 trillion on defense, that's going to be pretty good for at least that sector, right?
Yeah, it can certainly drive the story, and that to a degree is what's been reflected in the price action year to date. So you can have these idiosyncratic drivers continue to create outperformance of other regions, but I just don't think they can entirely decouple from the US.
Greg, thanks very much for joining us. Greg Boutle there from BNP Paribas. Coming up less than 4 minutes until the opening bell, we'll speak with Rob Arnott, Research Affiliates founder and chairman. Next, this is Bloomberg. We are moments away from the start of trading after a correction in the U.S. stock market yesterday. I'm Matt Miller. This is Bloomberg Open Interest. You're looking at futures that are higher. Katie referenced earlier a dead cat bounce, and that may be why we see green arrows here after a 10% drop for the S&P yesterday. The NASDAQ 100 was down 13%, and we'll see if we can recover some of that ground. You hear the opening bell down on the New York Stock Exchange. To my left, over here to my right, you have the NASDAQ. That doesn't matter. What matters is what kind of bounce do we get? How far do these big stocks that we're watching closely today, like Tesla, like NVIDIA, does the Mag 7 comeback help to propel a gain in ground on these big equity indexes? Katie Greifeld is right over here to tell us what we're looking at the open.
Well, in the first 30 seconds of this Friday trading session, the answer is yes. You take a look at these indexes behind me, really making up ground, not enough to change the weekly performance, but still the S&P 500 up about 0.9%. It's those big names that Matt mentioned that are really leading this market higher. The NASDAQ 100, where all of your big tech really lives, up about 1.3% at the moment. The Russell 2000, even the small caps, this is a sort of buy everything market, at least, again, in the first minute of trading. The Russell 2000 up about 1.1%. Whether or not people want to hold risk into the weekend remains to be seen. There's a lot of daylight before 4 p.m., but at least for right now, green across the board. Let's take a look under the hood where the action is. Tesla, as we've been mentioning, really helping to propel the Magnificent Seven stocks higher this morning, leading that rebound after the S&P 500 fell into correction territory, Matt, yesterday. A technical correction, if you will.
Yeah, absolutely. A 10% drop from the peak is how we describe a correction. You could have your own definition. It doesn't really matter. The point is, it's a drawdown bigger than the likes that we've seen over the past couple of years. Yes, last summer we saw a drop of a little bit more than 8% on the S&P, but it doesn't quite reach the big round number of 10. NVIDIA is a stock I'm watching closely. You can see the shares right now up 2.7%. It's a $2.8 trillion company, the second largest market cap in the world. So this gain helps to drive the broader index. As I said earlier, it's worth 6% of the S&P and 8% of the NASDAQ.
Yeah, it's hard to get much bigger than that. There's only a few more names in that rarefied air. One.
Apple.
Apple. There you go. Well, it bounces around a lot. Microsoft gets in the mix.
That's true. Microsoft. Yeah. I think this morning I looked. Microsoft was 2.815 trillion, and NVIDIA was 2.820 trillion.
There you go.
So very close.
I don't know. It could change today. In any case, joining us now for this conversation, the day after correction territory, we have Rob Arnott. He is the Research Affiliates founder and chairman, joining us in studio. It's great to see you in person, Rob.
Great to see you. I got to express some shock and horror. You use the expression dead cat bounce, but you love cats. What's with that?
I was thinking about other hideous phrases to use, bulls beating a dead horse. I don't know. I like to mix it up a little bit. But thank you for remembering that. I hope my cat isn't watching. Let's talk about this correction. We were speaking about this Bank of America note that came out this morning. Michael Hartnett saying that it's just a correction. It's not the start of a bear market. What's your view, Rob Arnott?
Well, Dave Nottig last night made the comment to me that this is the Tesla chainsaw massacre.
That sounds like Dave Nottig.
Yeah, I love the expression. Think back to the bursting of the dot-com bubble. The first 2 years after the bubble burst, the NASDAQ was down 50% on its way to being down 80% at the lows. Mm-hmm. And the Russell 2000 Value Index was up 53% in the first 2 years of that bear market. Shocking. If you have an opportunity-rich environment with some stocks remarkably cheap and other stocks remarkably expensive, you can have divergences like that. The take no prisoners bear market of the global financial crisis started with not much of a spread between growth and value. Mm-hmm. And we're back to territory similar to the year 2000 with growth stocks being approximately 8 times the valuation multiples of value. Historic norms are about 4 times. So value would have to beat growth by 100 percentage points just to get back to historic norms.
We have a producer in London, Dan Curtis, who is not only a genius, but an Olympic-level rower. He put together this interactive chart on the Bloomberg terminal that is so cool. And basically what it shows you is the distribution of losses on, what's this, your x-axis, and then the number of stocks on the y-axis, right? You can see that at the beginning there, you see a drop of only 339 stocks, but a 3% move, right? That's from the dot-com bubble. The next one is Monday. And then each of the next 5 bubbles is during the dot-com era. So this kind of proves your point that we had these big 2.5%, 3% declines, but they weren't all the stocks like they were during the Great Financial Crisis or during COVID. Where do you find opportunity in that case if you know that some are going to be survivors?
Well, firstly, as I said, spread between growth and value is 8-to-1. That means that if growth falls in half, value would have to go from, in order to stay 1/8 the price of growth, would have to go to PE ratios of 4. Wait,
do we still have a clear delineation between growth and value? I thought those two things had kind of merged.
I don't think there's ever been a more stark delineation between the two. The gap in valuation between large cap and small cap is also near record highs.
Right.
So I look at this as an opportunity-rich environment. We have capital markets expectations that we update every month on our Asset Allocation Interactive website. You've probably seen it. And on that website, we're forecasting Russell growth to deliver 0 return per annum for the next 10 years, and small cap value to produce 8%, non-U.S. value 10%. 10% returns per annum for 10 years is a wonderful return.
I hear small cap value, and I just think you have to have a really strong stomach to go into that space. A lot of folks have been burned there before. And talk to us a bit about value traps in this environment. You see a lot of opportunity out there, but how do you avoid stepping in a value trap?
Well, we sub-advise the PIMCO RAE equity strategies, which are deep value strategies that filter out, seek to filter out value traps. Almost all value traps fail quality filters. You take out the low quality companies and you eliminate most of the value traps. Every value trap at some point goes into free fall, and so you use a momentum filter and you get rid of most of the remaining value traps. So we've owned well over 1,000 stocks in those strategies over the last 20 years, and 0 have gone bust.
Are those filters having to work harder in this environment, though? Are there more value traps than normal?
I don't think so. The narrative is AI is going to put all of these small businesses out of business, and AI is the real deal. AI is AI is not new. I was doing neural nets back in the 1980s, but user-friendly AI.
You got an early start.
I did. I'm old, but user-friendly AI is brand new. The CEO of our company had a conversation with AI over this last weekend about AI in the context of human evolution. How does it fit? And the reply came back, and I'll send it to you.
Yeah,
the reply came back, and you wouldn't know the difference between it being a computer talking to you or a PhD anthropologist with a double PhD in philosophy as well.
I don't often speak to those folks.
Yeah.
Well, I have a friend like that. Actually, he's even older than you.
Oh, my God.
Gary Schilling always talks to me about, how much we spent, for example, laying fiber at the beginning of the 2000s.
Yeah.
And the return on that didn't come until much later. But, of course, the internet is still a very useful tool. We talked about EVs, right?
Yeah.
A lot of these EV companies are going to fail. Chances are, though, we're still going to all be buying electric cars in 20 years, right?
Oh, yeah.
What do you think about these AI companies that are now the darlings of the market? Are they still going to be, is NVIDIA going to be the dominant AI chip maker in a decade?
There's a lot of lessons from the dot-com bubble in 2000. If you take the 10 most valuable tech stocks in the world at the start of 2000, how many of those 10 beat the S&P 500 over the next 15 years? 0.
Wow. I would have said at least Amazon.
Amazon wasn't in the top 10. It was ranked about 27th.
Wow.
And Apple was ranked about 36th. It was on the brink of bankruptcy. So the top 10 tech stocks included the dominant player, subsequently was Microsoft. You had to wait 18 years for Microsoft to edge ahead of the S&P. That's a long time to wait.
Yeah.
So were these tech darlings in the dot-com bubble massively successful? Were they reshaping our future? Absolutely. Were they priced for perfection? Absolutely. I see parallels with AI. NVIDIA is a brilliant company with brilliant product and deeply insightful leadership, but it came into the year priced at 30 times sales. 30 times sales requires stupendous long-term growth in order to justify that kind of price. It suggests that there's going to be no serious competition for years and years and years to come. Competition will lower their market share, will lower their profit margins, and will eat into their pricing power. There's no question about that. Competition will come, just like DeepSeek came out of nowhere to challenge OpenAI's dominance. So the technological revolutions are wonderful for humanity,
right,
but not necessarily wonderful for their investors in the late stages.
Right. Yeah, and it feels like some of those existential questions really working its way through NVIDIA's stock, at least in the opening months of 2025. Before we let you go, Rob, I want to go to a recent paper because you've called NVIDIA a big market delusion in the past. And recently you write that big market delusions develop when investors anticipate that most early entrants in an exciting new market/technology will generate outsized returns. The recent EV craze demonstrate BMD's three-stage cycle of frenetic expansion, eye-popping valuations, and painful consolidation, especially when it comes to Tesla, down 40% year to date. I assume we're in the painful consolidation phase.
That's the painful consolidation phase. It is the Tesla chainsaw massacre. The EV bubble, and I'll use the word bubble, in early 2021, we called it as what's called a big market delusion. Big market delusion is a special kind of bubble where a new industry is changing the world, and everyone in that industry is going to be stupendously successful. Well, wait a minute, they're competing against one another. There's going to be winners and losers. And if the valuation multiples are high enough, you can be a winner in the business and a loser to your shareholders. And when we wrote that paper, there were 9 electric vehicle specialists. There, 3 years later, there were 30. Now there's about 25. And
Ex-China.
Including China.
Also, okay.
And the consolidation is happening. 0 of the 9 beat the S&P since that paper was written. Only 2, Tesla and BYD, have positive returns at all. So you can get a wonderful industry that's going to change our future and have the pricing of that industry such that the investors lose out. EVs are going to be central to our future. With autonomous cars, I can't imagine them going to a gas station and filling up.
Yeah.
I can very easily imagine them going to a docking station and charging up.
Yep. That's fascinating stuff and prescient paper there. Rob Arnott, thank you so much for coming in to 731 Lex and joining us. Rob Arnott there of Research Affiliates. Coming up, General Mills reports earnings next week. How's that for old economy? And Citi is anticipating a guidance cut for the cereal company. Top Calls is next. This is Open Interest.
This is Bloomberg Open Interest. Gains accelerating right now on the major averages. The S&P 500 up 1.3%. Big tech after its big bad day yesterday up bigly right now, up 1.8%. And even the small caps really extending their gains as well, with the Russell 2000 up 1.4%. Let's go now to top calls. Some of the analyst action in focus this morning. And first up, American Express getting upgraded at Baird, where it's no longer a sell. The analyst cites the company's more balanced risk/reward. Shares up 2.3%. Next up, Peloton getting upgraded to a buy over at Canaccord, with the firm writing that it's a clear leader in the connected fitness market and is on track for growth. That would certainly be good news, and shares up 10%. Finally, we have Citi opening a 90-day negative catalyst watch on General Mills. That company, of course, reports earnings next week. Citi anticipating a guidance cut. Now, coming up, the playbook for the 2020s may be the reverse of the 2010s. We'll speak with Joe Weisenthal next in our strategy session. This is Bloomberg's Open Interest. Welcome back to Open Interest. Taking a look at this rally underway. The S&P 500 up 1.4%. Big tech in the lead, and the small caps also getting in on the action as well. You could call it a dead cat bounce, Matt Miller. You could call it a face ripper as well. That's what you just said.
This market is ripping face.
Ouch.
It's actually not. I think you have to be up more than 2% on the index level before you're officially.
The NASDAQ 100 isn't far away.
Ripping face. All right, I want to get into strategy session.
Let's do it.
That's a new segment that we've got for you here on Open Interest. And we're kicking it off with one of our favorites. Bloomberg's Joe Weisenthal joins us. In his latest Odd Lots newsletter, Joe is arguing that the playbook for the 2020s is a mirror image of the 2010s. He joins us now to walk us through his thinking. I love this.
Thank you. Thanks for having me back. I love being on TV, sitting on the chair, talking about ripping faces.
I
miss this. No, I miss this. This is fun. I forgot. This is fun sitting.
We used to be on a show together called What'd You Miss?
Yeah, a long time ago.
I didn't know that you were on it.
It was great. Only marginally.
I went on that show sometimes.
Dude, I love the note.
Thank you.
Talk us through the parallels, or is it a parallel? The mirror image of the 2010s.
It's been something I've noticed. I've been thinking about actually for years now. I don't know. I started in 2021, 2022, that there are a lot of things about this decade that are like the last decade, except literally the opposite. All right, so the easiest one is just that, okay, last decade we were talking about underemployment is the sort of persistent economic malaise or whatever. This time it's obviously inflation, the exact opposite, et cetera. That's kind of straightforward. But there are other interesting things, too, that are sort of opposite. So, like, we had a little financial crisis in March 2023. That was regional bank centered as opposed to the money center banks. You think last time all of the anxiety was around the big banks. Even in Europe recently, last decade, the periphery, right? Spain, Italy, Greece, that's where the weakness was. The pigs, right? No one ever talks about them anymore. And then Germany was strong. Right. Now, those economies have actually done fine, or relatively fine, and it's really Germany that's the source of anxiety. So you can, go down the list and, find all these, sort of, macro phenomenon. Even, think about the Trump when he was the chaos candidate perceived to be going into 2016. Hillary was seen as the safe one. When he won that night, famously, futures plunged, and then it took a while for stocks to get comfortable with him. Exact opposite this time, where stocks shot up when he won, and now obviously.
Yeah.
Today we have the face ripper, but otherwise. Not so great.
Going down the list, reading it this morning, you could kind of get chills because it really is a mirror image. And even when it comes to global monetary policy, talk to us about China because China went big on stimulus.
That's the other thing.
I love this one. This is my favorite. Not just China, but the U.S. too, right?
But this one is really interesting. You could say that in China did the world a favor kind of in 2009. There was no growth anywhere. They're like, okay, we're going to be this one engine of growth, going really big on the fiscal. And it was the one thing that started driving commodity production, et cetera, because they're building all those trains and bridges, et cetera. You could say China sort of did the world a favor again in this cycle because we had all this commodity scarcity, tight supply chains, and China eased back. I mean, they sort of famously, they didn't go big on fiscal. Their lockdowns extended a long time, really sort of let that slump persist for a while. So at a time when there was a lot of sort of capacity tightness across the world, China once again sort of did the opposite of what everyone else did and kind of what the world needed, which was give the world a break. Because imagine if China had also done fiscal, the strain we would have seen on all sorts of commodity supplies.
Right. You mentioned also the U.S. I remember in TARP when they did $800 billion, right? And maybe it wasn't enough. It still took us until March of 2009 to finally hit a bottom in the market. Yeah. And this time during COVID, we spent way too much money, during and after.
We spent a lot. And the stimulus that Obama did, it was shovel ready. That doesn't get out the door very fast. That kind of stimulus, that sort of classical infrastructure stimulus. So we really did have a slow employment recovery. This time it was a lot of money, and it was pocketbook money. I mean, it's de facto, helicopter money, sending people checks directly. So the policy responses to the two crises, we should have done a lot of the stuff that we did this time.
Right.
Should have done that in 2009, but
and the opposite, right? We should have been Sweden.
Yeah, right.
But we ended up more like China.
Well, I mean, there's obviously investment we need to make, but the real economy. You think back to summer 2020, it rebounded a lot faster than a lot of people had anticipated on its own.
So, Joe, I know you haven't done TV in a while. We're out at 56:30, so you have about a minute for this answer. When you think about and you draw
Thank you for
draw this out, what does this say about the back half of the 2020s? We have about 5 years left. What does the 2010 say about how the rest of this decade will go?
Well, the thing I concluded my note on, which I think is very interesting, is that diversification has been for losers. If you're
only
for losers, only nerds diversify the last 15 or so years. And you're always saying you should be internationally diversified. You should have some bonds in your portfolio. And all this stuff and small cap. If you listen to those guys for the last 15 years, maybe you sleep at night a little bit better, but you're missing out big time. But in the last several weeks, or the last couple months, started this year, for the first time in a while, you're getting paid for international diversification. And German stocks have done well. I mean, even Canadian stocks have significantly outperformed their U.S. peers this year, which is pretty remarkable. EM, take a look at EM currencies. EM has been dead money for years and years. And EM is picking up. So I think this is something to watch if you're looking for these great reversals. It's only nerds diversify. and didn't get paid for it for years
We hate
and
them
years.
On this show.
Yeah, right. You guys,
Yeah,
are too cool for
fans.
them.
We're way too cool.
But
They're
maybe the
immortal.
nerds, maybe the people who like listen to all the things in the textbook about diversification,
Maybe they'll be okay in the end.
Yeah,
We threw those out.
Joe, great
saying.
having you on the show.
Thanks
Thanks for joining
having
us. Joe Weisenthal. Be sure to check out Joe and Tracy on their Odd Lots podcast. If you don't already, it's the most popular on Bloomberg. All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is on assignment. Let's take a look at the equity market right now. Big rally underway after what we saw yesterday. S&P 500 up 1.2%. We do have some breaking data at the top of the 10 a.m. hour, so let's see how that shakes things up. University of Michigan sentiment, the prelim numbers for March coming in at 57.9. The survey had been for 63, so a big miss there and much lower than the prior reading of 64.7. Again, 57.9. Then you take a look at the inflation expectations. That's where things got interesting. The one-year inflation outlook coming in at 4.9%. That is a big uptick from the prior reading of 4.3%. Then you take a look at the 5 to 10-year snapshot. The expectation there for 3.9% inflation, above the prior reading of 3.5%. Let's break it down now with Bloomberg's Mike McKee joining us at the desk. And Mike, this looks pretty ugly at first glance.
I think that's putting it mildly. This is particularly bad news because we have been talking a lot, or at least you guys on Wall Street have been talking a lot about the possibility of recession going forward, and recessions are confidence issues. When people lose confidence, they cut back on spending, and when they cut back on spending, companies cut back on production and jobs, and you know what happens from there. So to see such a fall is pretty scary. 57.9 from 64.7 is a big drop. I can look here and see basically how long it's been since we've seen anything like that. It is the biggest drop since 2022. And the lowest since 2022. So we're 3 years into a real issue here. And then, of course, the big move in the inflation numbers is really a surprise. 4.9 from 4.3 on the short term. The Fed has been talking about the fact that these numbers have moved up a little bit, but they aren't worried about it. But this will get their attention in the same way that Jack Nicholson bursting through the door in The Shining probably did. 5 to 10-year inflation, 3.9.
Johnny.
Yeah, they've been worried. They've been saying, you know, the long run is not a problem. It's the short-run inflation expectations that have us concerned. And at this point, the short-run inflation expectations are just as bad as the long run. Now, one of the things we have to check out with the University of Michigan is the sentiment indicators for the political parties. Democratic sentiment, 51.3, down from 65, whereas Republicans are at 86.7 from 86.7 unchanged. So this is really a shift in Democrats and independents. Independents fall off the cliff as well, 62.6 from 68.3. So a lot of people worried about this being just kind of a political poll. We'll have to see how Joanne Shu interprets this.
You see it, first of all, instantly reflected in the equity indexes, right? Because we were up 1.5%, more than that on the NASDAQ. And we saw a drop when there you see the drop on the S&P.
Yields also extending higher.
No matter who you are, no matter for whom you vote, we all eat bacon, egg, and cheese sandwiches.
Eat a lot of eggs.
Right? With coffee. And there's a new function on the Bloomberg that shows you the prices of those things. If you pull it up on I think it's an eCan function, you can see here in red is the eggs. This is a problem, right? This is the inflation as we see it in real time, and Americans expect it to continue to the upside with these tariffs.
The good news was that bacon went down a little bit in the last month in the CPI, but as long as eggs are continuing to rise.
Bacon is the dark blue here, eggs are red.
Yeah, as long as that's continuing to rise. And we've had an ongoing problem with coffee. So it's the war on breakfast.
Yeah.
Maybe that's what the administration should take.
Breakfast is more expensive than ever.
Michael McKee, thanks very much for that. I want to get right now over to Alex Chaloff. He joins us here on the desk from Bernstein Private Wealth Management, where he is Chief Investment Officer. And Alex, A, welcome to Open Interest. Thanks so much for joining us. B, I was looking at your note today and so thankful that you kind of quantify the effects of this tariff policy in earnings. Yeah. You've got a band, but you point out what we could be looking at. So it's no longer 14, 15% earnings growth, right?
Yeah, I think that's right. You've got to shave off at least 2%, maybe 8% off of S&P this year. So, 270 comes down to, let's talk 260. Maybe it's 250 in an out scenario, but it's definitely not going to be the kind of mid-teens earnings growth that everybody wanted.
I thought that was so interesting because it's been so hard to quantify. I mean, you listen to these earnings calls, you take a look at these releases, and these companies are basically feeling around in the dark because they don't know. So you took a stab at it, but it just feels like the band of potential outcomes is a lot wider this year. Is that actually the case, or what's your read?
Yeah, I would say it's impossible to forecast random. Right? We come into the year, we say, here's our upside, here's our downside, here's our base in the middle. And instead of widening them out, you're basically throwing a bunch of spaghetti against the wall. Because we don't know. We don't know what's going to happen with tariffs. We don't know what's going to happen with taxes. How's that going to impact interest rates? There's a deflation discussion, not just an inflation discussion that comes from tariffs. So it's all over the place. Very hard year this year to forecast anything.
So what is the sort of all-weather play that you make? Not specifically talking about risk parity here, but you write in your notes that diversification is working. We just had Joe Weisenthal on saying that diversification was for losers. But how do you protect yourself and your portfolio in a
Surely he didn't mean you, dude.
No. It meant everybody else.
Yes, yeah. Exactly.
No, look, last time I was here, I said, don't sleep on Europe. And Matt said, you're crazy. So I think that's paid off. I think owning stocks outside the U.S. has paid off. Anything outside of the MAG 7 has paid off. I talked about the forgotten 493 a year ago. Like that diversification, it's not sexy. It works.
Yeah. Well, actually, Europe right now, I think, is sexy. I was looking at a chart of European defense stocks, and they are ripping face.
So is Rick Reeder, apparently, because he's buying into European equities as well.
Yeah, it
everybody
makes sense.
is, by the way.
Dude, it was a great call. It was a great call. Having said that, I want to ask about the potential of a recession here, the potential of a bear market. We're journalists, so we tend to be sensationalists and alarmist, but you're saying it doesn't need to necessarily go that far to the downside.
No, I think, look, we're taking advantage of a pullback to reposition portfolios, to upgrade. I talked about, think of getting on an airplane and getting an upgrade. We're upgrading the portfolios today. We're taking advantage of where low profitability stocks have run. If you look at what's worked this year, it hasn't been the high profits. It's been the low profitability. So take some winnings there and trade into the high profitability names that have sold off. Look at earnings growth. The highest earnings growth companies have done the worst. So take some of the low earnings growth and trade into that at a discount. So there's a lot of opportunity to upgrade portfolios across the board.
It sounds like you're basically saying buy quality. You want to be looking for quality right now.
I would say look through what's going on today. Look through the last couple of weeks. Everybody was talking 6 months ago about, this is too expensive a market. What's going to happen on the other side? I'm nervous about putting new money in. We just got a little bit of a solution here, not a correction, just a little bit of a pullback that allows us to step in and pick our spots. So I would say less about trying to pinpoint the right company, but look through the noise today onto what the long term looks like.
What do you think about Europe? Right now we have a story on the terminal that Friedrich Merz has gotten the Greens to go along with his plan to spend $500 billion on defense and infrastructure. It's just, for someone who's lived in Germany a long time, that's just incredible. Do you take advantage of this kind of war trade or this, rebalancing of NATO trade?
Yeah, I think that the time to really do it, which was when we did it, was last fall, was a little bit of advance in the election and then piled in more post the election. We didn't know exactly how the Trump, Ukraine, Putin situation was going to play out, but it looked like that was a pretty likely scenario.
By the way, can you get in early then on the investing in Russia trade?
I think that's really, really early / don't do that. But I think that there was an opportunity to capitalize on what's gone on in the European defense names. I was talking to a family office yesterday and saying, here's what we did. And they said, yeah, you and everybody else But I said, well, we were last summer, fall, so we got a little bit early there. But I think now is time to rotate to general European economic names. So look to the European consumer, which people thought had gone away for years. Look to some of the more core components of Europe. Defense infra still there, but there's other ways as well.
By the way, Katie, I just put together this chart.
Did you?
There's a Bloomberg function that's coming out
I'm
next
sure
week for
there is.
clients, CHRT Go. And it shows a gazillion charts that are super searchable. So I looked in there and I put in defense stocks and I pulled up this chart, 3131 in the chart library. If we pull it up, and if you're sitting at home playing along with your Bloomberg, you can type GTV. That is the blue Goldman Sachs European Defense Basket, just walloping the Stock 600 Banks Index in white and the Stocks 600, the broader index, in yellow.
Well, to invoke Rick Reeder again, he's also increasing exposure to European banks, basically saying that they're very attractive today because they have the ability to do additional financing, and valuations still aren't that high. He came in a little bit later than you did, Alex, but I want to broaden out this conversation a little bit more and bring in fixed income, because fixed income feels like it's been really fickle. It's acted as a hedge. It hasn't on other days, and it's just hard to pinpoint where exactly it fits in the portfolio. So how are you treating it?
I think you have to look, again, this theme of looking past the current environment, look past the rate fall that's going on right now. We have a year-end number on the 10-year of 375 to 4.
Wow.
Now, we'll probably be closer to 4 than 375, but it's going to come down from here. It may not come down for the reasons that we all want it to come down. It might come down because of economic weakness and a little bit of a flight to safety. But the reality is we've got the yields that will act as a cushion. You're going to generate a positive return this year in fixed income in 9 out of the 10 scenarios that we're looking at. Now, is it going to be a 10% return? No. But you're going to get something positive. Like you said, when equities are selling off, fixed income generally has done well. So the cushion that we've been waiting for, and we got kicked in the teeth in 2022 to get here, but now we're here and we have that cushion, so we're taking advantage of it.
Capital appreciation and a return, right?
There you go.
It's a novel concept.
Alex, great having you on the show. Thanks for joining us on Open Interest. Alex Chaloff there of Bernstein Private Wealth Management. Coming up, the risk of a government shutdown has been eased. Nora Wittstruck of S&P Global Ratings joins us to talk about the budget negotiations going on in Congress. More next here on Bloomberg Open Interest.
All right, that was...
All right, let's get to high interest. Look at what's making headlines around the world today. President Trump appealed to Russia's Vladimir Putin to spare the lives of Ukrainian troops. Trump said they were, quote, in a very bad and vulnerable position. The appeal was made on Truth Social. Trump's post comes as the U.S. is looking to persuade Russia to agree to a 30-day ceasefire in Ukraine. Bank of America's Michael Hartnett says that President Trump is likely to intervene after the slump in U.S. stocks. He recommends buying the S&P 500 when it reaches 5,300 and says when we get down to those levels, it's going to prompt a flip in a tariff and monetary policy. And gold rises to a record high, topping $3,000 an ounce. It did. I swear it's come back down a little bit. As President Trump's tariff agenda fans concerns around U.S. economic growth, the precious metal is extending last year's gains, which were driven in part by central bank buying around the world. Let's shift our focus now back to Washington, D.C. The government looks like it will avoid a shutdown this weekend after Senate Minority Leader Chuck Schumer said he will give in to Republicans' demands that at least 10 of his Democrats vote for the spending bill. President Trump posted on Truth Social to congratulate Schumer and said that the big tax cuts, L.A. fire fix, and debt ceiling bill were coming. Nora Wittstruck, Chief Government's Analytical Officer for S&P Global Ratings, joins us here on set. Great to have you with us on Open Interest.
Thank you so much for having me.
Thank you so much for coming. So what do we make, first of all, of this bill that's going to be voted on today? I guess Fetterman was in already for the Democrats, and now they're going to contribute 9 more, at least, right? What does that get us through September?
So I think there's an important thing to remember here, which is this continuing resolution situation and the budget negotiations is fairly typical for the way that the federal government has negotiated their spending plan in recent history. There's been more than 40 continuing resolutions over the last 25 years. So it's not atypical that a continuing resolution gets passed versus the 12 appropriation bills that are needed to create a spending plan for the federal government. But I would say the main thing that we're watching is as the negotiations continue beyond the continuing resolution, what happens to federal funding that many state and local governments receive for a variety of programs like Medicaid, infrastructure spending, and also just for general things like FEMA when it comes to recovery from major disasters.
All right, but we're all focused on, well, potentially one big, beautiful bill, right? Or not. That includes an extension of the TCJA. That'll cost at least $4.5 trillion over 10 years, but also cuts of, I think the Republicans said, at least $2 trillion if you want to get that much in tax cuts. Is that going to work out?
Well, as a ratings analyst, I don't opine really or make a recommendation as to what they should or shouldn't be doing. But I think what we're watching.
All right, does that set us up to be a more credit-worthy borrower?
Well, the U.S. sovereign rating is not really my expertise, and that kind of negotiation would really be more aligned with that particular credit analysis. But I think what we're watching when it comes to the cuts that are made to afford the Tax Cuts and Jobs Act's extension is really how they transform Medicaid, which, states get about 25% of funding for that program through the federal government. Also, we're going to be watching as to whether or not they want to appropriate additional funding to refill the disaster recovery fund at FEMA. And also, we're going to be watching any additional clawbacks that have been made for infrastructure funding through either the U.S. Inflation Reduction Act or the Infrastructure Investment and Jobs Act.
Well, Nora, I'm really curious to get your perspective on a different type of cuts to the federal workforce, of course, spearheaded by Elon Musk to basically shrink the size of the federal government. What is the read-through, if successful, if we do start to see this show up in the data in a big way? What is the read-through to state and local governments?
So it's really could be a sort of a dampening of economic growth, right? If you have certain people that are not working or, certain people that are furloughed for a time, if there's a government shutdown, that could really dampen consumer spending. And actually, I think one of the gentlemen you had on previously was talking about the University of Michigan, and the consumer sentiment that they read every month is down about 10 points from January. So if consumers get uncomfortable with the direction of where things may go, whether it be they get Medicaid funding cuts or, there's something else happening in terms of their employment, they may pull back on funding. And that could really lead to a downward trend of some revenues that state and local governments collect to balance their budgets.
We should note that yesterday a federal judge said that they cannot fire these federal workers. So I don't know how many it is. I'd love to find a number. If you know one, please volunteer it. But we're talking about tens of thousands of workers, right, that are now going to be able to go back to work, and that there's unlikely to be a furlough since we're probably not going to get a government shutdown.
Yeah. I'll be setting my alarm for midnight to make sure that the CR gets passed.
I mean, how hard is it for you to forecast if not only do you not know what someone like Elon Musk and his minion of Doge teens are going to do, but you don't know if the justice system is going to allow any of it or stop it as illegal?
I think for us, that's really the uncertainty part of this whole situation, not only with the budget, but with some of the policy decisions and how the unpredictable nature of those announcements are kind of playing out, right? So we, have a hard time forecasting that uncertainty. But really for us, every sort of negotiation around federal policy around the TCJA is all different. And so for us, we really have to wait for those details to materialize before we can really make a determination on whether it's credit relevant or not.
Yeah, for better or worse, still in wait and see mode, it feels like, across a variety of different sectors. Nora, it's great to see you again. Have a great weekend when you get there. That is Nora Wittstruck, Meanwhile, let's get a quick check on these markets. Of course, we got a really ugly read from University of Michigan sentiment at the top of the hour. Inflation expectations, short and long term, also really rising higher, but still not taking too big of a bite out of this rally underway. The S&P 500 up about 0.9%. Big tech still in the lead, less so. It was up 1.7% earlier, but still a 1.2% gain there. And the bond
Nvidia
market
still gaining more than 3%, by the way.
There you go. I will note that volume is quite lower today, down about 11% from the 20-day average, but it is a Friday. Now, still ahead, Wall Street says that Chipotle is well positioned for tariff risks. We'll bring you the details next on Open Interest. All right, welcome back to Open Interest. It's time now for Social Climbers, the company's making waves this morning. And first up, Ulta Beauty reporting fourth quarter earnings that beat estimates. And Wall Street analysts are saying that actually the company's full year outlook might be conservative, which helps explain the 9% pop in shares. Next up, Chipotle getting upgraded at Loop Capital. The analyst cites a very manageable tariff risk since it sources only about 2% of its total input from Mexico, which I certainly found surprising, but Chipotle shares up about 1.2%. Finally, DocuSign is posting quarterly results that beat expectations. Wall Street calling it a solid quarter overall, and the CEO will join me and Jackie Davalos next hour on Bloomberg Technology. But before we get there, let's get another peek at these markets. Of course, we've been following this rally as it develops, this bounce back from the wipeout that we saw yesterday and really for the past week or so. The S&P 500 up by more than 1%. It's big tech that's leading the gains right now. It's been leading the declines over the past few weeks, but at least for right now, of about 1.4%. And then the bond market, it's not a hedge, but it doesn't need to be today. It's actually selling off. Remember, we got that data at the top of the hour showing that inflation expectations are rising, and you can see yields rising as well on your 10-year Treasury yield. Now, coming up next, we'll talk to Ryan Serhant, a luxury broker with deep expertise in closing multi-million-dollar real estate deals next. This is Bloomberg. Well, intense competition for Manhattan apartments drove rent prices to a new record high in February. The median cost of a new lease is now $4,500. This trend is expected to continue as economic uncertainty keeps some home buyers on the sideline. But when it comes to the ultra-luxury market, buyers may still be willing to splurge. For more insight, I am thrilled to say that we're joined by Ryan Serhant. He is luxury real estate broker and star of Netflix's Owning Manhattan. Great to see you in person.
Thanks for having me.
So the story that we came in on, the fact that rents in Manhattan hit a record high in February, Matt makes fun of it because I think we've been running that story.
I mean, rents are always hitting record highs in Manhattan, you know?
Yeah. Well, take us into that market because, I mean, you deal with the ultra-luxury buyer, but you also play in some of those markets as well. So from where you're sitting, what's your read on the direction of rent prices and especially relative to the actual ticket price to buy right now?
There is an absolute affordability issue. You know, we spend more time thinking about affordability with our customers because we have to help them think about where to live based on what they can afford and what that monthly payment is, more than we think about the next highest price, because that's a solid headline. For example, we sold an apartment yesterday in the West Village for $60 million. It's the highest price ever paid for a residential home in Lower Manhattan history. Hit the Wall Street Journal, I think, 12 hours ago, give or take. But there's an affordability issue and there's an affordability opportunity, especially with the super rich. Rents are high because inventory is low and because there's market uncertainty. When people are uncertain, especially if they're looking to rent a one-bedroom or a two-bedroom and they're comparing interest rates and they're looking at their potential monthly payments, then they stay renting. They don't move. Right? So you have that stagnation. People stay or they kind of move in with roommates. And so that's why you're seeing those rent prices go up.
So your show's Owning Manhattan.
Yes.
Right? But I think a lot of people who are buying are going to end up in Hoboken or in the Bronx or in Queens.
Or Jersey City.
Or there. You know, I'm trying to offer you some alternatives. Are you seeing more and more people buying in the outer boroughs? Are people willing to commute longer, 40 minutes, an hour and a half?
Well, we have since COVID began, right? So about 5 years ago. But a lot of that has changed over the past year. There's been a big call back to the office, as we all know. But if you're able to have hybrid work still, or you can work from anywhere, I mean, our strongest markets are not urban markets, right? Urban markets are coming back, but they're becoming pied-à-terre markets. New York City, I think by 2030, will probably be the pied-à-terre capital of the United States.
Interesting.
Everywhere else, people are moving. They're willing to commute if they don't have to be into the city on, let's say, Mondays or Fridays. We just opened, Serhant, Georgia. So we're in Atlanta. We're in Savannah now. We're about to open our first market out west, which I didn't think we would do this soon in our company's lifespan. I only started Serhant in 2020, but we've been moving incredibly quickly. And there's strong demand for property everywhere as people diversify assets. And you're seeing interest rates come down. I think we're at 6 months loans for end users, right, who are purchasing properties. Energy's down, right? Rates are down. The 10-year is down, so you've got deflationary measures that are happening now. So I think that consumer confidence will come back, and we feel pretty good about the market going forward in 2025.
Well, selfishly, I do want to ask you about Jersey City, but before we get there, I want to go back to the point you made about pied-à-terres in Manhattan. Who's the buyer base there? Is it Americans, U.S. citizens, or are you seeing foreigners more come into this market?
We're seeing some foreigners start to come back into the market, right? That's a currency exchange. We spend a lot of time thinking about those foreign markets. Our platform, through our sellit.com platform, has 40,000 real estate agents in 133 countries, and we sell with them every day. And so we've started to see a real uptick in the past, let's say, 6 months of foreign capital coming back in, and not from kind of your standards, not just from China, it's not just from the UK. We're seeing a lot of money coming in from across Latin America. We're seeing money come in from places like Croatia. Really, really interesting countries that typically weren't on our standard purchaser radar. But you have a lot of domestic wealth that's been created too, which is kind of what happens when you pump the system full of $4 trillion, right? So you have a sugar high that has just risen to the top. I think a lot of that fiscal stimulus has risen to the top, and it's gone into equities, and it's gone into things like real estate, which has pushed asset prices across the board. I'm excited for the volatility. Just to put that on record, the volatility is a good thing, and the cooling off from the sugar high that we've experienced over the past couple years is a good thing. I have a 6-year-old, and when she has a sugar high, like, you look at that playroom, and obviously it's crazy, and obviously there's toys everywhere, but sometimes it's okay to put the toys away and to start fresh.
So you're rooting for chaos, you're getting it, and I think that wealth effect that you're talking about certainly has been coming off the boil in the past few weeks, just looking at the equity market. Let's go back to Jersey City. You mentioned that the 10-year yield is coming down. Mortgage rates slowly but surely are coming down. I just about live on Zillow right now, and I see a lot of Serhant there.
You should go to Serhant.com. It's clean. It's
good. When I go to Zillow, what I like about Zillow is that you can plug in different mortgage rates. Yep. So I can look to the future and say, okay, in the future, when rates go back to 4%, I hope, this is what I'm going to have for a monthly payment. When do you think we'll get to a level that starts to unlock some of the folks like me who actually have been on the sidelines waiting for rates to come down?
So you're not going to get back to 4% anytime in the near future. 90% of all home loans in the United States are under 5%. If we can get to a buy down area where we can get into the 5s, we unlock inventory at a scale that we haven't seen in a long time. Remember, the last 3 years in a row, we've got home sales absorbing at like 30-year lows. And it has not changed because we've got to fix this inventory problem. So my hope now is that by creating this kind of volatility and this chaos, we're going to be able to bring rates down. The Fed will come out, right? They won't feel as sticky. Hopefully they're going to do either a 50 or a 75 basis point reduction, which would be massive for us. That brings more inventory to the table. It brings more buyers to the table. Affordability starts to becoming a good conversation this year. And I think you'll see hopefully close to 5 million home sales in the United States this year versus the 4 million annually we've seen year after year.
I just want to point out that over the past 50 years, the average 30-year mortgage rate has been 7.73%.
So we're good.
Yeah.
What's everyone stressed about?
Can I dream? Dude, can I dream a little?
You can dream.
A 4% mortgage rate, I think, would indicate probably a pretty bad economic situation. But I digress. Let's talk more about Serhant, because We had a great story earlier this week, and an M&A deal. Rocket Mortgage bought Redfin.
Yeah.
And
all stock.
We were all sitting in, I'm sure you paid close attention. We were all sitting in the meeting room thinking, I wonder what Serhant would go for. You know,
where's that media room? Can I go over there?
Have you had talks? Have you considered the possibility of M&A? Maybe even not a sale, maybe a purchase, maybe a partnership?
So the Redfin deal is interesting, but I called it roughly 2 years ago. I don't know what show I was on, but said mass consolidation is coming. And it's not just in the real estate brokerage business, it's everywhere, right? Anytime you have 50% less trades, you put margin squeeze on companies where that margin is crucially important, especially when they're low on cash. So then you have to look at these master plan partnership collaborations. And so I think you're going to see more of it. There was a big article about a potential huge real estate brokerage collaboration happening yesterday. Whether it's true or not, I'm not sure. But you're going to see a lot of that.
Tell us a little bit about that.
So, there was an article yesterday. It's been denied by everybody that Compass is looking to purchase Berkshire Hathaway Home Services.
I saw that, yeah.
Right?
Berkshire was down big in the
which
free
would
market.
be great. A mass consolidation, I think, is great. Our business plan is completely the opposite. I think it's the right one. I'm not sure. Maybe time will tell. I'm a real estate agent at heart, and I understand how this business works from the point of the salespeople who are our actual customers. But our growth has been completely organic. We're about to open a state coming up on Monday, so I can't say until Monday, but we're opening with about $530 million in trailing 12-month sales.
Wow.
That has cost me next to nothing. If I'm a traditional brokerage going and trying to do that same type of expansion, that's tens of millions of dollars in expense because I'm buying revenue. We don't buy revenue. All of our growth has been organic and completely earned. And so therefore our sales have been earned. Our cost of leads is next to zero, and our margin profile as a brokerage is so different. But we're a private company and we're only 4 years old. So I'm watching this landscape, these consolidations, and watching a Redfin, which I think has the highest multiple in the public space of about 2. Super exciting, and then watching like a Compass, which has a multiple of, I think, 0.6, or like a Douglas Elliman, which trades at like 0, and it's wild to watch the future. And so I'm very excited to be in the space that we're in.
Yeah, absolutely. And you'll just have to come back on Monday when you can talk a little bit more about that. But I do want to, before we let you go, talk a little bit more about ultra luxury. You mentioned that multi-million-dollar sale.
$60 million.
$60 million, West Village.
Yeah.
Let's also talk about 200 Amsterdam, specifically Residence 41, selling for about $20 million
on Tuesday.
There. Yeah.
It's been a busy week.
Tell us about it.
So I believe very, very strongly in the power of content to audience, to community, to commerce. And we do it for real estate. No one else does it. I don't know why, but we do it incredibly well. Our distribution funnel is bulletproof. Our exposure is large between Netflix with 300 million subscribers, our social channels with nearly 10 million followers. So 200 Amsterdam is a unique story, right? That's a $20 million apartment. So we got the apartment. We featured it in a movie called Baby Girl with Nicole Kidman.
I've heard of that.
We put it into 0 Day, right? A show with Robert De Niro that just came out on Netflix. We put it into Succession. Prior to that, I've walked through it with Matt Damon with Water.org and Amazon. We just had Mr. Beast come through it, and it sells because it's all about who knows what you're selling. Traditional forms of media and exposure are just, again, they're right? They're traditional, and the world has changed. And so our ability to put listings and buildings in front of more qualified eyeballs than anyone else with a kind of trickle-down media funnel is really, really unique, and it works. We just sold a property in Palm Beach for just under $200 million a couple weeks ago. It was also in the news, and how that deal came about is pretty similar.
All right, Ryan, unfortunately, we have to leave it there. Hope to speak to you again soon, especially as I get deeper into this home search. But Ryan, have a great weekend when you get there. That is Ryan Serhant of Serhant.
I see a $20 million apartment in Jersey City in your future.
That would go a long way in Jersey City, but we'll just have to keep checking Zillow and Serhant.com. Meanwhile, let's get a check on these markets because you have that rally accelerating right now that we've been talking about. The S&P 500 up 1.3%. The NASDAQ 100 up a little bit more. What's leading us higher is Tesla and NVIDIA. NVIDIA up about 4% right now. That is your biggest gainer on the S&P 500 from a points basis. You also have Tesla higher as well by about 1.6%. That certainly doesn't hurt, Matt Miller.
Yeah, no, that's helping the bounce back. But of course, we come off of correction. Yesterday, we were down 10% from the peak. Nora Melinda, sitting right here to my right, watches stocks for us at Bloomberg News. Nora, what do you know?
Well, let's take a look at some of the names that are in the green. I'm keeping an eye on Peloton. We know that this has really been a beaten down name. It used to be a pandemic darling, but then we did have it fall, and there are some loyal, faithful customers, and that's what people are saying will really spur the rally later on. So we did have the shares jumping 43% just last year, and we're having Canaccord. They're calling it a clear leader in the space. They're saying that they got into the industry early on, and that will really help accelerate them moving forward. So we are seeing shares getting a bit of a pop right now coming off of that news.
Crown Castle?
Yeah, also keeping an eye on Crown Castle. This is up in my space in real estate. This is a tower REIT, and we're seeing it's the best performing stock right now in the S&P 500 by a percentage basis. It's a Houston-based tower REIT. It reported earnings, its FFO beat, and it's selling its fiber business to an EQT fund and Zio Group for $8.5 billion. So that's a big number there. This deal is expected to close in early 2026. But we are seeing these shares getting a pop, and also Raymond James and also KeyBank coming out and upgrading the stock.
Yeah, shares up 8.5%, a nice pop there. Just quickly, tell us about what's going on with Rubrik.
Yes, Rubrik, that is a data security software company. We're seeing shares surging, double-digit gains, up more than 20%. And this is all really based in this idea that it had an outlook that beat expectations. It came in stronger than expected. And investors, Wall Street is really calling for this idea that it may be actually able to bypass its peers. So we are seeing some support from investors here.
All right, and the CEO of Rubrik coming up on Bloomberg Technology as well. Bloomberg's Nora Melinda, great roundup. Our thanks. Meanwhile, coming up, what does a successful CEO do after they step down, but they don't want to retire? They start another career. In today's Wall Street Week, David Weston sits down with former Netflix CEO Reed Hastings on his second act. This is Bloomberg.
Time now for a Wall Street Week conversation. After 25 years as CEO of Netflix, Reed Hastings decided to take his love of skiing and make it his next business venture. David Weston sat down with Hastings in Utah to discuss his second act as owner of a partially privatized ski resort community.
We're at Powder Mountain. It's 10,000 acres of skiing, one of the largest resorts in the world. Half of it roughly is public and half of it is Powder Haven, or a private skiing resort. And it's been tremendously exciting these last 2 years to be putting this together.
You might recognize Hastings from his 25-year tenure as CEO of Netflix. He joined the board of Bloomberg LP in October of 2023. Hastings started Netflix back in 1997. Growing it from a DVD rental service with $270,000 in annual revenue its first year into a global streaming giant, bringing in $33.7 billion when he stepped down in 2023.
David, we're one of the areas that is a new neighborhood coming. So it's beautiful aspens, incredible views. There'll be 37 lots here. That's our land.
But through it all, Hastings maintained his passion for skiing.
When did you first ski? Where did you find your love of skiing?
Well, I was fortunate that my mom was a skier, and so we skied most years as a Christmas vacation. But I wasn't hardcore, I wasn't a ski racer, wasn't all of that. And that was up until I was 20 or so, and then my 20s I didn't ski. And then 40s and 50s, we had kids, and we had a place in Park City, so that was tremendous. But again, I was, full-time at Netflix, so I was maybe 10 days a year of skiing. What had happened in Park City is long lines, big crowds, no powder. So we moved here, which is about an hour away.
Do you remember the first time you came to Powder?
Yeah, absolutely. It was Christmas in 2016, super crowded in Park City. Drove over here, and then it was just wide open, incredible Powder. We fell in love with uncrowded, the high altitude, which keeps the snow very good, and the community, very warm and generous.
What's up?
And then I retired from Netflix and then invested in Powder and eventually started running it.
You heard that right. Reed loved the mountain so much, he bought it. The Netflix tycoon is now taking on a new challenge, building and partially privatizing a ski resort community after identifying a part of the market he thought wasn't being served.
You're only really making a difference when you're changing the rules. At Powder, we're the first one to be fusing private club skiing and public skiing together. In golf, about 25% of U.S. golf courses, 4,000 and 16,000, are private. And that's because you get better tee times, you get a clubhouse, social interaction. Sometimes they're residential, sometimes not. But in skiing, it's really just been Yellowstone Club and Wasatch Peaks Ranch. So we're only the third out of 500. So there's tremendous demand as people move to the subscription club orientation. So changing the ski industry is something that's the next big challenge.
And that was David Weston speaking with Reed Hastings. You can catch Wall Street Week every Friday at 6 p.m. Eastern, including today. This is Bloomberg.
Equities in Dallas as the Texas Stock Exchange pushes its way into the ETF world. It's also taking big names from the like of NASDAQ and CBOE with it. Joining us now, I'm pleased to say we have Athanasios Serhant of Bloomberg Intelligence. I'm referring, of course, to the announcement yesterday that the Texas Stock Exchange is taking Rob Morocco, signing on with the Texas Stock Exchange. Also, Allison Hennessy of NASDAQ joining the team as well. And this was a surprise to many in the ETF world, Athanasios. And for many, it was a statement of intent. What do you make of the moves?
Yeah, you're spot on. It was because those are two really big names in the industry. And this is honestly one part of the industry that could use more competition, the exchange side. But honestly, it's a tall order. It's really hard to kind of steal listings from the NYSE and the NASDAQ. So in order to do it, you're going to have to hire some big names. There's a third exchange, there's Cboe. They've had some success in trying to, list new ETFs. So, they have some work ahead of them, but I think this is a good start. It's also important to mention that the head of the NYSE also stepped down, doing the one who's handling ETFs.
Yeah.
They left too. So there is some opportunity there to try to maybe capture some gaps.
Yeah, Douglas Jones, now the CEO of Direction, I believe. So there's a lot of changes underway when it comes to the exchange side of things in the ETF world. But talk to us about how to attract listings. I mean, the Texas Stock Exchange, it doesn't really start until 2026, I believe they're targeting for their start. How do you go about attracting ETF issuers to break away from the NYSE, to break away from the NASDAQ and Cboe, and actually go to this upstart?
Yeah, I think the best way to do it is you're going to have to come up with some sort of incentive, whether it's, hey, we're going to incentivize market makers to want to provide quotes here, we'll give them rebates, or we'll give tax benefits. That's the only way you could really do it. That's really how Cboe started to do it. And then you eventually have to carve out a specialty. So for example, Cboe really specializes in options. So what if they find something, whether they want to be the thematic exchange or something like that, that's where they're going to have to approach it, because like we said, it's really hard to pry it. But once you get a couple big listings or even get a switch, that is going to start to get a lot more attention, and then switchings tend to follow. So it'll be hard to get the first one, but I think if they're able to pull that off, the secondary ones will be much easier to follow.
What will the NASDAQ and the NYSE be doing to compete? Are we going to see, for example, 24-hour trading 7 days a week?
Yeah, and they're also already starting to roll that out. But again, it's a really tall order. And this might sound really basic and primitive, but there's a lot of prestige and cachet with being listed on the NYSE. That's why they have such strong market share in ETF listings. You get the ringing of the bell ceremony, all of that. Because when you look at trading, a lot of them are very competitive, whether you're on the NYSE or the NASDAQ. So they have to start offering something that is in addition to just good execution, because you're probably going to get that on all the exchanges. And the other thing that they compete on is indexes, right? So as ETFs have gotten so big, you want to be in the NASDAQ 100, you need to list on the NASDAQ and so on and so forth. So if maybe they can build out some big index business, and if you want to be included in that, you need to list in Texas, that can also start to maybe
all right,
attract.
Athanasios, up against the clock. Great to get some of your insight here. That is Athanasios Serhant of Bloomberg Intelligence. Tune into ETF IQ every Monday at 12 p.m. Eastern. Subscribe to my newsletter as well. But that does it for Open Interest for this week.
We'll see you again in 4 minutes on Bloomberg Tech.